Are all businesses the same? Are some small and some big? What are the types of business entities? I'm Thomas Harwood and welcome to the Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at what are the types of business entities. There are numerous types of business, which range from a small business that could be on your local high street, or a large global business which has hundreds or even thousands of stores just in one country. First of all, there are four main types of business entity. They are sole traders, partnerships, private limited companies, and public limited companies. If you have not already guessed, a sole trader is the most common type of business. A sole trader is a business that is owned and controlled by one individual. Sole traders do not have a separate legal existence from their owners, and as a result, the owners are personally liable for all the business debts, and in some cases may have to pay the debts out of their own pocket, known as unlimited liability. Sole traders can range from a hairdresser to a builder or even a sweet shop. A partnership is the next step up from a sole trader. It is where two or more people own a business. A partnership is quite similar to a sole trader, whereby the owners are equally and personally liable for the debts of a business. Partnerships share the responsibilities of the owners, as well as profits and losses. It also allows more capital to be contributed by the owners than a sole trader. However, there is a high chance of dissatisfaction and disputes happening between the owners. Partnerships can include dentist practices, small solicitors agency, or even an accountant's firm. Let's now move on to the next type, the limited companies. A limited company is briefly an organisation which has separate legal identity to that of its owners or shareholders. Limited companies have limited liabilities, meaning that if a business failed, the maximum amount a shareholder could lose would be their investment, i.e. shares, and their personal possessions, i.e. assets, would not be used to pay off the company's debts. The next type is a private limited company, or LTD. These businesses are usually family owned, and the directors are often majority shareholders. They cannot offer shares to the public, making it more harder to raise money, and it is more difficult to take over as an external party or investor. Also, the financial information must be filed with the Registrar of Companies. Private limited companies include a chain of fish and chip shops, a group of local building contractors, or a group of grocery stores. Now, the final type is a public limited company. This is where a business is registered under the Companies Act and where two or more people are required to form the company, assuming it has a lawful purpose. It can offer shares to the public on the stock exchange, which can mean the company has better access to capital and liquidity through selling shares. Although this is good financially, the company will be under greater public scrutiny on their actions and performance, and the financial markets will control the value of the company through trading the shares. Examples of public limited companies include a majority that are household names and exist on mainly every high street and shopping centre, and in the United Kingdom you would be able to exchange shares of them on the FTSE or NYSE in the US. So, that was the identification of different types of business entities. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click the red subscribe button to keep updated with the Accounting Student. Thanks for watching. We'll see you next time.